This episode is brought to you by SixPark. SixPark is one of Australia's leading online investment managers. SixPark sets you up with your own globally diversified investment portfolio and manages it for you. Investments are overseen by the SixPark Investment Committee, which includes Brian Watson, the former chairman of JP Morgan, and Lindsay Tanner, the former Minister of Finance for the Australian Government. To find out more or take their free online risk assessment, visit sixpark.com.au. You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back to the channel, or welcome back to the podcast, the Young Investors Podcast, episode 69 today. If you're listening to this on Spotify or Apple Podcasts, then definitely go check out the YouTube version of this one, because we're doing another live podcast. And first of all, joining me as always is Hamish.
Hey, how's it going?
I'm going pretty well. I'm pretty excited for today's podcast. It's going to be a good one.
It's going to be good. Back-to-back podcast, live podcast.
Yeah.
It's been a busy week.
It has been a busy week. How are you holding up?
Yeah, I'm holding up all right. Getting there.
How's the persistent cough, the fever, and the fatigue? Is that calming down?
It's of course.
Okay, good.
Yeah, I got my test back, and the second test was negative. First.
Anyway.
Terrible joke.
I'm cutting you off there. We've got a very special episode today because joining us today is 2012 Sydney Swans Premiership player and 2012 All-Australian, and recently Sydney Swans Hall of Famer, so congratulations on that. That's an epic achievement. Ted Richards is here.
Thanks very much, guys.
Yeah, thanks very much for coming on. And we probably should say that you're also the head of business or director of business development at SixPark as well, which is, of course, what everyone knows you for.
Yes, yeah.
No, but thank you very much for coming on the podcast. So we're going to be talking today about a range of different topics. Of course, we've got to cover what's going on in the markets at the moment. We should note that we're recording this on the 20th of March, 2020. So this will come out in a couple of weeks. So if things change, then we're sorry, but we're covering it as best we can.
So much seems to be changing even intraday. So should we even say what time we're recording?
It's 10:28. I wonder what the ASX is.
So true. Even if we uploaded it this afternoon.
Who knows what's going to happen this afternoon?
It's been crazy, hasn't it?
How's the ASX go? Is it down yet? Who knows? Probably down another 3. We'll just go, ASX is down 3%. We're all scrambling to find
up
out.
3%.
Up 3%.
Wow.
Well, the US, the S&P 500 went up a little bit overnight as well.
It did,
so.
Yeah, it did.
Yeah, but it's obviously super volatile times, super unpredictable times, but we'll still cover it anyway. But I guess the first question I wanted to ask you, Ted, just for all of the listeners out there, is what personally for you, what's kind of your approach to investing? Because the viewers know how we go about our investing. How do you kind of think about your investing? What kind of philosophies or strategies do you follow?
Yeah, I guess so much talk about is just jumping right into it and investing, but I think a lot of the work needs to be done before you even get to that stage. And that is to ascertain and work out what your risk profile is here. And that's probably just a bit of a fancy word to describe something that encapsulates your investment horizon, your investment experience, investment horizon, risk appetite, and investment experience.
Right.
And so if you put that all together, even though we might be all of a similar age, if you're saving up for a home deposit, that is very different to your putting your investments towards your superannuation. And that needs to be taken into account, because when you go through something like we're experiencing right now with this crash, if you're investing with a 20 or 30 year investment horizon, it doesn't matter.
Yeah, exactly right.
It doesn't matter. Like, if anything,
it's exciting.
It's exciting, because as your salary gets continually paid into your superannuation, you're buying at a discount.
Yeah.
However, if you're saving up for a home deposit and you're hoping to be in the market in the next 6 months, something like this can be catastrophic for your opportunity to get this together. So I don't want people to think that an investment philosophy comes back to at SixPark, we're quite passive in that it's a cookie cutter approach, and that we have the same investment approach for everyone.
Yeah.
No, we ask some important questions beforehand, and it's incredibly important because when people are nervous, which they are right now, you can really go back to the reason why you're invested and ascertain those goals and say, well, this is still going to get you the goal that you're after, you know, the retirement, or if they're in a more of a conservative portfolio because they want to achieve a goal in the next few years, that they're still on track. So I guess that's one part of our investment philosophy. The other part of our investment philosophy is once someone is invested, we're not highly active. We're quite passive, which I'm sure your viewers and listeners are familiar with that term. But in that, we believe that the two things that we want to focus in on is keeping fees low for clients, because that is one of the few things you can control, and the other is asset allocation. So much of what Australia talks about is stocks and equities, and to be fair, it is exciting. I love it too, and Australians, we are we love property. You know, it's stocks, property. And it seems like there's no other asset classes that Australia wants to talk about.
It's true.
Very true.
Oh, it's true. It's one or the other, basically.
And I'm guilty of it too. Like, if someone wants to talk to me about bonds, I'm like,
oh, that's boring.
See you later.
Yeah.
But bonds, they form an important part.
They have their place.
Yeah, in an investment portfolio, and so does cash.
Right.
And it's in times like now where if you've got some defensive asset classes in your portfolio, that's providing the stability so you can rebalance and start to buy up these equities, which are now a discount, because that's the role that these defensive asset classes play. But so much of Australia doesn't want to talk about, you know, boring asset classes like that.
Yeah, that's very true.
So, and that's part of our investment philosophy too. So, Aussie international equities, property's got a role, bonds have got a role, cash has even got a role, and put that together for a client according to their risk profile.
Right. And you briefly mentioned rebalancing. So does that mean that when economic conditions change, investors should be doing something differently? What's sort of your view on that? And
I guess the best way to answer that question is to say what's happening for a lot of clients, for a lot of Australians right now, in that if they're got quite an aggressive growth portfolio with a large allocation to equities, because the valuation of the equities has come back a bit, they've drifted from their target asset allocation. So they need to be rebalanced. And that means because the defensive asset classes, which have held up quite well and provided that level of resilience, is now in a disproportion. So,
that makes sense.
So it's that rebalancing process is just ensuring that they're back consistent with their target asset allocation. And like I said, that's for someone that's got a high allocation to equities. What we're seeing, say, on the flip side of that, is someone that might be close to retirement, as equities are increasing, which has been happening over the last decade, is not ensuring that they're not overexposed to equities, because when this crash occurs, which has, we want to ensure that they're still able to achieve their goals, especially if they're close to retirement, and they're not going to. They can still sleep at night, knowing that their quality of life in retirement isn't being affected.
Yeah, I think that's something that I think it was Ben Graham, Intelligent Investor, talks about as well. I think he uses the example of stocks and bonds rebalancing based on a certain risk profile. So I can understand why that's happening, and I think it's probably pretty important. You're right, because if you're someone that's getting ready to retire, you don't want to find that you're waking up and you're accidentally, through the movements of the asset classes, you're in some high growth portfolio that might be taking on more risk as opposed to more like fixed income or something like that.
It's quite interesting right now, because a lot of people close to retirement or in retirement have been looking to blue chip Aussie stocks, be it
BHP,
Rio,
bankings.
and the banks as a bit of a bond proxy. It's quite a defensive equity.
Right.
In that they provide an attractive dividend, in the vicinity of 5-6%.
Yeah.
And many, and I view incorrectly, have viewed that as their defensive exposure in their portfolio.
Yeah.
But a bond is a bond.
Yeah.
An equity is an equity.
That's true.
An equity comes with equity risk. And what we're seeing right now is that thesis play out in that investors may have been loading up their portfolio to try and get this 5 or 6% yield from an equity. But what they're saying is that's playing out in capital losses because CBA, one of the bluest of blue chips there is in Australia, is now back probably north of 30%.
Yeah. Exactly right.
And someone was heavily invested in this one company to try and get 5%. So I think that's why it's important to acknowledge that an equity is an equity and comes with risk, and these events can happen. And a bond is more so the asset class that provides that resilience.
Yeah, well, I mean, the bond, it tells you right on it what you're going to get, and that's vastly different to a bank. I mean, it's easy to kind of say, oh, it's been around for so long and it's such a big bank, but I think most people probably don't understand how a bank functions. I mean, I certainly don't know how a bank functions.
So circle of competence
understanding what you're actually investing in and knowing what you're going to get out of it. The bond tells you what you're going to get out of it.
Yeah. So, and to be fair, most bonds have actually come back a little in the last 2 months too. But so if you don't understand a lot about how a bank makes money and the net interest margin and the effect that
put my hand up there.
lowering interest rates is going to have on the ability to make money there for a bank, I'd suggest that it probably is outside of your circle of competence.
I wanted to kind of flip the story. So we talked about kind of the different situations in life and particularly touching on retirees and the complications they might find taking on equities risk. I wanted to flip it over now to the people that are maybe young, like us really, and they're thinking about getting into the market. I suppose they see this dip in the market in the US and here in Australia, and they go, oh yes, here we go. Like, I've been thinking about this whole stock market investing, my mate Hamish told me it's a good idea to be invested, start building wealth. I understand that you have particular knowledge in the whole concept of behavioral finance and the role that emotions play on investors and the different biases that are associated with investing, the whole psychological side. So I was wondering, from your experience, for someone that is brand new, getting ready, like, oh yeah, I want to invest in the markets, what's kind of, I suppose, your pre-game pep talk or maybe disclaimer that you might tell someone from your experience knowing about more the emotions that people might experience in the markets and what to be wary of?
Yeah, I guess my answer doesn't waver from the first part of the investment philosophy with Six Park, in that if you're investing right now, you've really got to acknowledge your risk profile.
Just know what you're getting into.
Investment horizon, investment experience, appetite for risk.
Right.
Because if you're investing right now and you think, I've got a 12-month investment horizon, I want to make 20 or 30%. Whoa. Yeah, whoa. Yeah. If you think you want to get in the market and you want to start day trading, this...
Calm down, boy.
Yeah. However, if you've got a 10, 20-year investment horizon, I think there could be some fantastic opportunities. But, I certainly believe there'll be bumps in the road ahead, though. So that's that, acknowledging your risk profile, because if you do have a short investment horizon, I think it is dangerous just to load up on stocks, in the fact that there could be another sell-off, or God forbid, another black swan event. Yeah. So that's addressing that. The other aspect is what's going on right now, and that is what I want to speak to there is when emotions are high, logic is low. There will be so many different headlines people will will read, and investing is hard. Yeah, so people might think of what a great opportunity it is, but I don't want people to think that it's easy. Yeah, so I guess that probably is my
It makes sense as well. I always go back to the idea of people, wanting to get started with investing. And I think I heard you talk about this in one of your podcasts that I was listening to the other day. And they want to start, they see Microsoft or Google or Facebook, Tesla or whatever, and it's gone down 20, 30%. They're like, oh yeah, I could pick some stocks here. And I think it's important also to tell, or just to mention to new investors that actually what you were saying before, it is quite difficult for someone that's new to outperform the market as a whole, just diving in and trying to pick individual stocks. And I think the thing that you were talking about in your podcast was the Spiva graphic of talking about how many active funds actually just don't outperform the market. They just underperform.
Yeah, the majority of Australian and international fund managers underperform their benchmark. And these are people that have been doing this for decades. Incredibly intelligent, doing it day to day. And if you are doing this on the side as a bit of a side hustle, or as a bit of a hobby, what are you bringing to the table that gives you that edge over a Hamish Douglas at Magellan, a John Sevier at Airlie? That's why investing is hard, and it's part of the reason why it's almost a rite of passage. I feel that in life we always have to kind of early days go through a bit of a learning process where we lose a bit of money.
I remember us talking about that on the last podcast about we were saying how early days we just thought we were hot shots and lost money, and it's a very humbling experience getting started in investing.
Well, it's pretty hard to have lost money if you've been an investor over the last 5 or 10 years, in that pretty much everything's gone up. But it's in times like now that we all get tested, and so I don't want people to think that you can jump in and it's going to be easy and you're going to make money and it's going to be fine, because the reality is it's just not like that. And if you're lucky enough, it is like that. It probably comes down to more to luck than skill, in that you just got in at a fortuitous time.
Yeah, maybe we can talk about that for a little bit. Have you? I was just listening to the Judd, one of your version of the podcast, and you discussed one of his earlier investments that you were talking about just making mistakes when you were getting started. Is there any specifically that you remember? Any mistakes? Any investments that you made early on? And
so I was lucky enough to get drafted when I was 17 into footy, and read a few books, one of which was Peter Lynch, One Up on Wall Street, and which was written back in the 80s, and it's a fantastic...
Still a good book.
It's still a fantastic book, but it was well and truly before ETFs had the availability that they are, and I started to see things that I thought was a good buying opportunity, and some of those played out and some of those didn't, and I lost money here and there, made money here and there, and I think sometimes it was probably just more luck that I bought it at a good time, and I think that people that just look at a chart and go, oh, look at it's going down, it's a good buying opportunity. Well,
how do you know?
How do you know?
We were talking about that yesterday a little bit as well.
There's a reason why airlines are going down right
now.
Because they very well could fall over.
We were talking about that specifically yesterday, about the flawed logic behind buying a stock or thinking that a stock is on sale just because it's gone down 20%. That there's just people that will jump in and say that online or whatever. You just always have to remember that the prices can do whatever. They could go like that, they could go down like that, but you have to, if you want to get into that game of trying to select individual stocks, you have to have at least a good understanding of what that underlying value is of that business to be able to put that share price into context. So we were talking about this yesterday, about just the flaws of thinking when the markets are going down, it's just like, oh, the market's gone down, so everything, like, it doesn't matter what I buy, I know I'm getting it at a discount specifically because it's gone down 20 or 30%.
I think it's a great point, because there's a lot of people that might be looking at Aussie retail companies, whether it's something like a Myer or a David Jones or an Adairs or something like that, and going, oh, what a fantastic buying opportunity. I'm 37, you guys are well younger than me. We don't know what it's like to go through a recession.
Yeah.
You know, we've never lived through a recession. I think the last recession, I was 7.
Yeah.
When the
In
last
Australia,
recession.
Yes.
So, how are these Aussie retail companies going to give, survive? Some of them survive through a recession, especially if they've got a high level of debt.
Yeah.
They might have come back 40, 50% and look attractive. But who cares if it falls over in 12, 24 months' time?
Yeah, no, it's true. And we cover just general market news on our podcast from week to week. And it seems like for Aussie retailers, we're probably covering one news story a week, where there's another one that's fallen over and another one that's fallen over. I think we saw that particularly towards the start of last year as well. But you're right, you look at that sort of space and you're like, doesn't matter if it doesn't matter if it's gone down 50%, if it's going to go down to 0.
Yeah, and it's incredibly sad when you see and hear the stories like of Flight Centre, which were one of the first companies to really, I think they have flagged that they're going to close 100 stores or something like that. It's sad that these ripples and what that'll mean for all the staff of these businesses, but it's a reality that we haven't experienced over the last 3 decades.
Yeah, and I mean, when a stock price goes down, I mean, the market is wrong sometimes, or you can make that argument, but I think most of the time it does quite a good job, at least over the long term, of pricing assets. So, it was a good discussion yesterday about people thinking a stock falls 20%, it's 20% on sale.
Yeah.
Or maybe its value has gone down 20%, or maybe it was overvalued and now it's fairly valued.
There's a lot of those. Yeah, it's a lot of those. I don't know, almost like biases or just lines of thinking
that are just illogical.
That seem logical, but in reality are not logical.
Yeah.
I'm guilty of talking about companies being on discounts and things like that right now. The analogy that I like to kind of describe valuations is, I think Howard Marks uses the analogy of a pendulum, and that more often than not, the pendulum is either at one end of the spectrum in terms of valuations. Very rarely is it in the middle.
Yeah, that's a good point.
So very well, we may have gone from things being overvalued and quickly to being undervalued. I've got no idea. That's just putting it out there.
Yeah.
But I do like the theory that it's not just sitting in the middle all the time, providing a clear, accurate idea as to correctly what things are valued at.
Definitely. People are always, or a lot of the time, either overly optimistic about the future or overly pessimistic about the future. It's fascinating to watch how quickly a business like, I talk about Facebook quite a lot, and how in 2018 the stock price went down 40% in 6 months. And it's kind of crazy to think about a business that has, 3 billion monthly active users, having its stock value erased by 40% in 6 months and then back up 100% in another 6 months. That's clearly an indication of that.
We talk about efficient market hypothesis.
Yeah.
And how it's still, you were saying it's still got taught to you.
Yeah.
When you're going through uni.
Yeah, well, fortunately, they teach us behavioral finance and efficient markets. So they give you sort of both sides of it. But I think it's very clear that efficient market hypothesis is not, at least in the strict definition of it, is not a reality.
And I'd agree with that.
I'd probably walk out of a lecture that was on efficient market.
I did a few times.
Oh, yeah. You walked out of all your lectures.
Yeah.
Do them online later.
Didn't go back.
What should we talk about next? I got a couple of questions here. I guess I've been getting a lot of comments, and I'm sure you've been the same, of people that, what we were talking about before, young people experiencing what's going on in the markets for the first time, maybe even children when 2008, 2009 happened, so they weren't paying attention at all, obviously. And then a lot of people come in with the excitement, as we were talking about, of the market coming down, but also the fear that the market's going down and that maybe it could get worse. So a lot of people right now sit at home and they wonder, oh, okay, so maybe if I'm just a purely passive investor and I track the market, that's all I do, and I want to invest for, 20, 30, 40 years. They're still sitting there and wondering, should I buy now or should I wait? And obviously we can't answer that question because it's highly individual. But I'm wondering if someone says that to you based on your knowledge of behavioral finance and the markets in general, kind of what runs through your head when you hear someone say, "Oh, should I buy now or should I just wait on the sidelines a bit longer and see what happens?"
Yeah, we've been actually getting that question a lot.
Oh yeah,
and I think there's, with a portion of people, this thinking that there's going to be some identifiable bottom that many smart people are going to see, and whether that's some event or some smooth transition into some flattening or plateauing of the ASX, that doesn't happen. And what even makes it even harder to distinguish is to when the best buying opportunity is some of the worst days from a stock market perspective are within 2 weeks of some of the best days.
Right, okay, yeah.
So if you think you're going to be able to dodge the horrible days but capture the fantastic days,
good luck.
Yeah, good luck. You got no chance.
Yeah.
And if you do, you're just so lucky.
You've lucked out, yeah.
In my view.
Yeah.
In my view.
I'd agree with that.
Yeah, I agree with that.
And what we're seeing right now is, it was about a week ago, the market went back 10%. And then a day or two later, it was back up 7 or something. There's no fundamental and rational reason why we're seeing this.
Yeah.
I think it's happened 3 times now.
Yeah.
It's gone down, up, down, up, down, up.
And so if someone wanted to work out if and how they should invest into this market, I'd probably speak about the benefits of dollar cost averaging into the market, which I'm sure your listeners are aware of, to hedge your entry into this market so you're not overexposed to if there is a further 10 or 20% or even more drawdown from here, but you can still capture some of the upside if we are at the bottom right now.
So I wanted to move on and talk a little bit more about behavioral finance, because I'm really intrigued by it. I feel like I've learned bits and pieces of it, but I've never studied economics or anything at university myself, just kind of learnt it all myself. So I feel like from my dumb definition, I'd say that behavioral finance is just analysing or exploring people's emotions to do with investing. Would that be a good one-line explanation of it?
Yeah. That's a good way to describe it. I think of it as the crossover between economics and psychology.
Right, okay. That's probably a good way to think about it. And then I guess that leads... I think a lot of investing actually is psychology. People talk about numbers all the time and charts and annual reports and this, but at the end of the day, a lot of it's psychological. And I find that particularly for new investors, they're very much influenced by their emotions, perhaps not without even realizing. So I wanted to talk about, from your perspective, what are some of from behavioral finance perspective, what are some of the maybe biases or thought processes that usually plague new investors that actually they should try and be as self-aware as possible and realize that this is probably what they're going to experience and try and look beyond those things? Yeah.
So very quickly, behavioral economics or behavioral finance describes I guess this acknowledgement that, economics assumes that we're always rational and we always make these fantastic decisions that are in our best interest. And when you put behavioural finance together, it's an acknowledgement that we don't always make these fantastic rational decisions. And before I get into the investing part, these heuristics and biases describe some of the ways that we can make decisions.
So it's more decision making.
Yeah. So and how we're influenced in decision making,
right?
And how investing is related to that, because investing isn't so much the study of pure numbers; it's the study of how we behave with money.
Yeah.
So,
that's a good definition, yeah.
So some examples of, I guess, what we're seeing right now is confirmation bias in terms of where we put the we put our opinion first, and we look for all the things that we can find can support that, and we discount everything that disagrees with that. Right. The one that's probably most prevalent right now in investor mindset is loss aversion, and that is the feeling we experience when we lose something is twice as powerful as the experience we gain when we get something, and that's probably the one that we're seeing so much in the industry right now.
That's probably what, I guess, drives the fear of stock market crashes, and probably why they're so severe.
Yeah,
I would imagine.
Yeah, I think you're exactly right.
Right. Okay. So loss aversion. So that's the idea of people feeling the hurt of losses more than they feel the positivity of gains. Right. So that does make sense of why it can cause that kind of slippery slope downwards. Let's talk about more confirmation bias. So, because I think that's one that investors should be particularly wary of as well, because it's very much a human shortcut. I mean, it makes sense from a human being perspective, because we want to be as efficient as possible in making decisions. So we do look for confirmation bias. So do you have any ways that maybe you yourself try and, like a rules-based approach to investing, or any ways that you personally get around the idea of, okay, as a human being, I'm probably going to, if I love Teslas like I do, I'm going to look for information that says Teslas are awesome. Are there any ways that you kind of make sure you don't slip into that confirmation bias?
Yeah, I guess with confirmation bias, and so many of the other heuristics and biases that we'll speak about, being aware of it, it's not like, I'm aware that I've got I suffer from confirmation bias. Yeah. I'll make sure I don't suffer from that. Yeah. And it'll be like, these things are just a part of how we make decisions, whether we're aware of it or not. And
being human. Yeah.
And confirmation bias is incredibly hard to sidestep. Incredibly hard. So you've probably got to actively seek out people and opinions that disagree with yours, and not get into a fight with them.
Yeah.
Because...
Jeez, wouldn't that be nice?
Oh, yeah. Well, when it comes to politics, you see that play out. Whether it's, Liberal and Labor, or Democrats and Republicans.
Yeah.
But actually do your best to try and take it on board, what they're saying to you, and challenge yourself in terms of... So right now, people... we've actually actively spoken about that it might be a buying opportunity right now in what we're seeing in the market. Maybe I'm suffering from confirmation bias.
Maybe we are, yeah.
And maybe we should be pointing more to, maybe I should be considering more the reasons why there's far more downside to come. And I'm sure an Italian fund manager is probably a bit more pessimistic as to their view on life, as to, say, a fund manager that's in Singapore that, it looks to be like in the world's best approach in terms of getting people en masse through something like this.
And I mean, with the internet, you would kind of think that we have more resources available to maybe try and overcome some of these biases. But then I think about how YouTube recommends videos and
algorithmic.
I mean, we spoke about like Twitter
showing most relevant posts.
Exactly. If you're watching a type of video, you're likely to see more of similar videos, and it's not just in finance.
In fact, I would say that the social media promotes confirmation bias, because it's in their best interest with their business model to show you the stuff that you want to look at.
That they at least know that you're interested in. Yeah.
So these different forms of technology have got fantastic choice architecture to make sure they get you to do what they want. Yeah, and when it comes to choice architecture, one of the most powerful things is defaults. So with the onboarding of applications, you might see pre-selected all these tick boxes in things that are not in your best interest, but they want you. But I want to be fully upfront. There's been times over the last few weeks where I'm checking my what's going on in the US in the middle of the night, and
I've been doing that as well.
And there are some times where I won't even logically see what the numbers are, but I just see a screen of red, and my heart probably just starts bumping on that.
Yeah,
just because of this, what that triggers in my brain.
It's interesting,
and I'm aware of that because I can't go back to sleep.
Yeah.
And then when we're in Facebook or Instagram or whatever it is, and you get a notification, bang, up pops a bit of red. So it's fantastic. It's incredibly smart what
they've done.
They've got it figured out.
Yeah. To
maybe not for our best investing interests, though.
Yeah.
We've got some more biases that we've noted down, but I don't really know what they are. Let's start with overconfidence bias, because I feel like that is kind of self-explanatory. I feel like I could explain what overconfidence bias is, but I don't know. So I was wondering if you could talk about maybe overconfidence bias, and is that something, I feel like that might be something that new investors bump into a lot as well.
Yeah, so also related to something called the Dunning-Kruger effect, where...
that sounds familiar. I can't remember.
Yeah, where once we have a little bit of experience in something, be it investing or coronavirus.
Yeah,
I think we're playing out right now. Some people, and possibly a lot of people, can quickly become an expert.
Right.
And I did read somewhere that an age where a lot of investors peak in confidence is around our age.
Right. Okay.
Kind
of early days,
especially for males. And it's so humbling to see these the Berkshire Hathaway AGMs where
so good,
Buffett and Munger will sit there at the age of 80 and 90 and just answer questions, like simple questions. I don't know. I don't know. And so I think they try and mitigate this overconfidence bias and the Dunning-Kruger effect by just acknowledging it's okay to not know about something, and it's okay just to say, well, I know a little bit about it, but there's still so much I don't know.
I think that kind of goes back to this whole topic gets pulled into various aspects or different notes of investing. The one I think about is like circle of competence, and Warren Buffett's idea of circle of competence is you don't need to know everything about everything. You just need to know. You need to know what you know, but more importantly, you need to know what you don't know.
Yeah.
And just don't step over the line. Don't go into that area when you know you don't know what you're talking about.
Yeah. Howard Marks, who's I think he mentions it's not how big your circle of competence is, but an acknowledgement and an awareness what is inside and what is outside the circle. And we spoke about bank stocks before. Mining stocks, BHP and Rio, which so many of Australians turn to. If you don't know how BHP is making money and what's going on with their debt and what's going on with currency exposures with China or be it a bank, and what's going on with bad debt defaults, fair to say those two industries aren't in your circle of competence.
Yeah, I mean, I think people would be certainly a lot better off if they just recognize that most businesses are so complicated. Like even for myself, like restaurant businesses are some that I look at, and even though there's really only a few moving parts, they're still highly complex, and it's very difficult to figure out which ones are going to grow and expand. And then, you look at a business like biopharmaceuticals, and I just think, how could you possibly understand the patents and all of the other things going into that?
The chemistry behind it. There's many aspects that you have to wrap your head around. And that's why I like Warren Buffett Charlie Munger's approach of buy simple businesses. Well, don't just buy simple businesses, but look at businesses that are simple. For instance, like a bank is something that it would take me so long to understand, if I even could understand it completely. But you can look at a business like Facebook, which has its complexities, but at the end of the day, if you look at their annual report, it goes, 98.5% of our revenue was made by selling ads.
Yeah.
Full stop. Next, it's like 1.5% was selling virtual reality products or something. So I think there's something to be said as well for looking at simple businesses, and like what you're saying, not tricking yourself into thinking you're an expert in everything, which I think is quite prevalent in today's day and age. Do you want to talk about hindsight bias?
Yes.
I don't know much
yeah,
about
so
that.
I don't know much about this either. But again, I mean, some of these, they seem a little bit sort of intuitive, but I'd love to hear your explanation of it. But tell us a little bit about hindsight bias.
Yeah, hindsight bias, it pretty much is what it sounds like, in that it's a misattribution of memory, in that when we look back on events that happened in the past, we assume that we remember our behaviour to be differently, or we think we might have even behaved it. And so, for example, I guess the last crash that we can speak about is the financial crisis of 08 and 09. And many people go, what a fantastic buying opportunity,
Right.
Well, hang on. People were shitting themselves. The banks are going to fall over.
Collapsing,
Like that capitalism was going to fall over, and governments were going to be stuffed. And and to be fair, we did see some banks in the US fall over.
Yeah.
I
know a few people who watched The Big Short and were like, I could have looked in the mortgage-backed securities. I could have done that.
And the reality is, like, right now, people are panicking. People are, leaving their houses, their apartments, and this is all logical and rational. But at some point in the future, I don't know when the future will be.
Yeah.
There will be some people that looked at and go, and may be of the view, why didn't people just kind of carry on and live with life normally? Which, or it might be the opposite and go, what do you mean people were still going to supermarkets? I've got no idea where we're going to be at in the future. I do remember I was lucky enough to have I was playing football in 2007 and was lucky enough to have a bit of money around then. I can remember I was shitting myself back in 2008, 2009, just seeing like on a day-to-day basis.
That's what was happening,
losses, compound one after another. And there might be people that look back and go, well, you could have just loaded up with everything you had, but it was tough back then.
Yeah, and you even now I'm hearing people say, well, this crash is different in this way, and I since this is sort of the first thing I've gone through, I can now sort of, from a first-person perspective, appreciate how people think every time a crash comes that it's different. Like, it's not going to recover this time. Like, this one is going to last much longer.
What you hear and what you see.
Yeah.
Every crash is different from a narrative and a catalyst point of view. Maybe not every, but like whether it's too much fear and there was a bubble, or there was some societal problem, be it I don't know, a war or a disease, a virus, but we can learn from history, despite the narrative and the catalyst being different. The recoveries are normally somewhat similar, in that over a period of time, be it months like 1987, or years like the Depression, which was probably the longest that I can think of. We do know over time that markets historically trend back up, and it's being able to be rational and focus in on that, as opposed to the day-to-day noise that's going on at the moment.
One thing I wanted to ask you about as well. Now that we're talking about all these different biases and we're really getting into the emotion side of investing, I'm interested to gauge your thoughts on the idea of paper trading for new investors, the idea of, for people that don't know, the idea of making some sort of account where you get to, it's like simulated investing, you get to buy and sell stocks, but there's no money involved. I'm wondering your thoughts on this, because for most people they say, yeah, it's fantastic, it's good, because it gives new investors a way to understand, like, what a buy order is, what a sell, like that sort of stuff. But there is that other side of the coin where paper trading with no money involved will usually tend to make people make bigger bets because they know that there's no risk of losses, and it could lead to things like overconfidence bias. If they do particularly well when they're paper trading, they jump in real life and it's not as easy as they thought. I'm wondering just generally what your thoughts on paper trading are. Is it something that you kind of think that would be mostly beneficial or maybe not as beneficial? I'm just interested to hear what your thoughts are.
It's not something that I've thought about a lot, but I do think the more research people can go through and practice, the better.
Yeah.
I think maybe to coincide with that, an investment diary where you jot down your thesis as
that's a good idea.
why you're investing in something. Because say you invest in company A and it goes up, and you invested for a certain reason, but that actually doesn't play out, but it still goes up because
maybe everything's going up.
All the boats have risen up together because it just so happened that you were lucky and that you invested at the bottom. So I think having an investment diary can complement a strategy like that, just to kind of
maybe keep yourself in check a little bit or something like that.
And I think a lot of the fund managers do things like this, have some form of checklist, because there'll probably be times when, say, the market comes back and you've really got to check if that thesis still works, or if it's materially changed and you exit that position. But to be honest, it's not something I normally think about that much.
Okay. Yeah, I'm not sure. I think paper trading gets a little bit. It has a better rep than it should. Because
positives and negatives.
There are positives and negatives. I just think if you're not trading your own money, loss aversion is the bias that comes to mind, that it wouldn't impact you if it's not your money. So a person,
you hit a reset button.
Yeah, exactly. You
can't do that.
You lose $50,000 on paper. You just
reset.
Okay, let's try again.
Jeez, imagine that. That'd be nice. Oh gosh.
Yeah, but I just don't see how it can provide as good as an environment for practice as just trying with a small amount of money could. I think that would probably teach you a lot more in my eyes.
So wrapping this whole podcast up, I wanted to talk about your involvement with Six Park. Now, we talked a little bit at the start of the podcast, kind of how Six Park kind of thinks about investing. I'm curious as to just quickly how you got started with Six Park, and even just your kind of transition out of your AFL career into what you do now, how that kind of came about.
Yeah, so I studied whilst I played football, did a Bachelor of Commerce, Masters of Applied Finance, and then worked for 6 years whilst playing footy. 2 years in the sell side at Citigroup in institutional sales, and then 4 years under a fund manager studying stocks. And so got a passion for investing. I love it. And over the course of my footy career, I could see a lot of teammates, people in your age, not making smart decisions when it came to investing. I'm sorry, I'm not casting any dispersions on you,
but like young people in general, with money,
young people coming into a bit of money.
Yeah.
And we might have seen it, with cryptocurrencies recently, and there might be something else that pops up again soon. But for most, investment management and advice is actually quite expensive.
Yeah.
And so a lot of these teammates were doing it themselves and just making poor decisions. Yeah. And I'd heard and been introduced to this business, Six Park, that was actually providing an accessible solution for Australians to be able to provide them advice, provide them with management in a low-cost way, just to help with the investment process, because it's bloody important. You work hard for your savings, and the ability to put things in place to improve your quality of life for later, be it in retirement or before retirement, is really important. And so with so many different businesses leaving wealth management in Australia for so many reasons, that's part of the reason why I was happy to join Six Park.
Right. And Six Park gets called robo investing, and I remember when we spoke last time, we all kind of came to the conclusion that we don't really like the name robo investing. So I just noted down what what you suggested it be called. Is you suggested it be called digital investment management or online investment management. So I was wondering if I'm coming to Six Park and I want to get started with investing, what does Six Park actually do for me as the client, and how do they kind of set me up for my investing approach?
Yeah, so unfortunately there's no robots. Which is a bit underwhelming for some people.
Coffee?
No. So if you come to Six Park, the first thing we're going to do is ask you about a dozen questions to determine your risk profile.
So talking about that same stuff as
investment
before.
experience, risk appetite, investment horizon, these questions. Put that together, give you a risk profile, which could be a balanced.
Yeah.
And then make an investment recommendation according to that. And it's not like, all right, balanced. Well, let's load up on these equities. But it's actually, all right, let's diversify.
It's multiple asset classes.
Multiple asset classes, from stocks through Asia and the US and Europe, global property, infrastructure, bonds, cash. Put that together for you, and however much you'd like to invest. Minimum investment's $10,000. Yeah. And then manage it for you. And
okay, so it's all it's pretty hands off from the client.
It's hands off. We execute the trades for you.
Right. Do the rebalancing.
Rebalancing. Provide you with reporting. The investment philosophy isn't highly sophisticated. It's getting you returns on asset allocation and keeping your fees low. It's we're not picking stocks where there's
But that's also what I look when I listened to your podcast and you were talking about it more with, I think his name was Pat.
Yeah,
Pat. Yeah, you're saying it's not the most mind blowing. It doesn't make you want to go, oh, this is so exciting. But it's still evidence based, and it's not sophisticated, but it works. Like the more passive investing approach, it works. I suppose.
I do think about, there are so many people that go, I want to invest in this because I might be able to, double my money in 6 or 12 months. Yeah. If you're always trying to be the best, and get the best returns ever, it's going to come with risk. Yeah. And with investing,
it's going to be extremely hard too.
It's going to be extremely hard. With investing, I think it's far more prudent to ensure that you are never the worst.
Yeah, that's a good.
And that's not our motto or anything like that. But that
Here
is
at
something.
Six Park, we're not the worst.
Well, it's so important because I can really, if you lose your portfolio goes down 80%, you don't need the portfolio to go back up 80% to be back. I think you need it to go up 400%. Yeah. So who cares if you might have done 20 or 30% one year, but then you'd back down 50% the next year. Yeah. It's more about just getting those good returns year after year, rather than try and shoot the lights out in 1 year and hope you can do it again.
Yeah. So taking from what you were saying before, so it's a more, what Six Park offers is a more passive investment approach, and then it's based on your risk profile. Then you kind of get, your portfolio is constructed with a different weighting towards different asset classes. Would that be a kind of a good summary of?
Yeah, it's acknowledging that it's not a cookie cutter for one size fits all.
Yeah.
And that a 60-year-old with a 5 or 5-year investment horizon is different from a 25-year-old that wants, that maybe have a 10 or 20 year investment horizon. That's just two examples.
Yeah. And if someone wanted to get more information or wanted to contact you guys to discuss more about their risk profile or investing, where would they go? Do they contact you through the website?
Yeah, go to the website. In the middle of the website is a button, Try Six Pack Now, and that's they can take the risk assessment there. It's completely free.
That sounds like a good place to wrap it up. So lastly, I just wanted to say thank you very much for your time today. It's really good to be able to come out here and thank you for inviting us into this studio space and being able to chat to you for an hour of your time. We very much appreciate it.
No worries, guys. A lot of fun.
And thanks always, Hamish, for joining me.
Thanks for having me.
And thanks very much for listening or watching. And we'll see you guys in the next episode.